Kevin Smith, founder and CEO of Crescat Capital, is joining us, and Kevin has been very vocal about how he feels we're entering or are already in a bear market, and that he has been predicting a global equity implosion, in fact. So Kevin, given that you have a history of outperforming the S&P, why do you feel we're currently entering a bear market in the US particularly? How severe could it be, and what are the indicators you're tracking?
Okay, well, there's really two main reasons that we think we're entering a bear market. The first is valuation reasons, and there's at least 8 different fundamental valuation measures that we've calculated that last year reached historic all-time highs. And the second reason is really economic timing indicators, and there's just a whole host of them that we could get into. In terms of the severity of the bear market that we're looking for U.S. stocks, we think given the valuations and just to get to the median multiples, we're looking at a 40% type of a bear market. But as you know, markets don't tend to stop at the median; they tend to go from bubbles to busts, from greed to fear. So we're looking at something more like a 50 to a 70% type of a correction.
You know, global equities have rallied year to date on hopes that a US-China trade deal will come through, and that the pause that we're expecting from the Fed tightening cycle can perhaps extend the expansion that we've seen economically. You've actually said that the Fed move at this point is indicative of a bearish trend, that it's the first sign that things are actually going to go down south. Explain the thought process there.
Yeah, that's a really good question, because a lot of people think that with the Fed pausing its interest rate hikes here, that we can have a soft landing or an extension of the business cycle. And we actually really got the pause in the Fed hiking cycle back at the end of 2015 that led to an extension of the business cycle, and the soft landing we think already happened in 2016 with the reflation that happened as the Fed went on pause for over a year in its interest rate hiking cycle. Well, since that time, the Fed has raised another 225 basis points. And if you think about it in terms of rate of change, it's actually the largest interest rate hike in a Fed rate hike tightening cycle ever. And so the idea that when the Fed pauses, it's bullish is really not true when it's late in the economic cycle at record valuations. And we're in the longest U.S. expansion cycle now ever, tied with the 1990s, and with the current quarter. And so it's just normally when the Fed pauses late in the cycle, it's because they're doing it for a reason, that something is wrong, that the economy is slowing. And they're afraid of the risk of asset bubbles bursting.
Right. Kevin, morning. So are you also tracking the inverted yield, which has really, made everyone take notice as a signal of an oncoming recession in the U.S.?
Well, yield curve inversions really are a very good economic timing indicator, both of impending bear markets and recessions. Now, there are times when, there are a few times historically when you've gotten some false signals. I think you have to go back to 1966 and maybe 1978 to see a really significant false signal from a significant yield curve inversion. This time we have more than 50% of the U.S. yield curve inverted. And when we were at similar levels of inversions, that was either the height of the tech bubble or the height of the housing bubble here in the U.S. And while people think that the yield curve, at least when you look at 2s versus 10s, inverted here in the U.S. back in 2006, and it took another really almost 2 years before the market started to correct. They think, oh, well, we have another 2 years. Well, that's not really true. And 2s versus 10s is not actually really the best segment of the yield curve to be looking at. Actually the 3-month versus the 10-year is probably a better better one to look at, and that just inverted last week. And I think we really need to be careful here, given the record valuations and all the host of other economic indicators that we look at. You can't just look at yield curve inversions alone to see that it really is a time to be concerned. And when the yield curve inverts, it's for a reason. It means that the economy is signaling that it expects the Fed to have to ease soon, and that's because the economy is slowing and the credit markets are trying to tell us something.
Right. So, Kevin, you've said that this is part of a global debt problem and cited $90 trillion in the Chinese banking system, highlighting a global debt contagion. You're shorting China, Australia and Canadian banks. So when is it and how is it that do you expect this contagious credit bubble to actually burst?
It's true that we have record debt to GDP levels globally, and some of the biggest credit bubbles in the world are in China, in Australia, in Canada, and we tend to see housing bubbles in those countries as well. There's 60 million empty apartments in China. So this is not just a U.S. stock market valuation bubble. We have asset bubbles globally, and at Crescat, we're a global macro asset management firm. We use valuation models, equity models, and macro models to try to time the business cycle and to look across the globe. So the timing indicators are, in terms of yield curve inversions, are not just in the U.S. Hong Kong actually has the record number of inversions in the yield curve today at over 60%. Canada has a high number of yield curve inversions today. So does Australia is rising, and so these are the housing bubble countries, and we're short banks in those countries, and we're short U.S. stocks as well. We do think there are a number of economic timing indicators. Globally, there's a global yield curve inversion when it comes to Fed funds versus 30-year rates in at least 15 different countries that are inverted today. It's kind of a global yield curve inversion, and so we think there's just a number of indicators that we could get into, but we do think that the timing is coming. The global markets, we think equity markets already topped out in January of last year. The U.S. market topped in September of last year. And what we've really seen year to date in 2019, we very strongly feel is a bull trap. It's a bear market rally that across a number of different countries in terms of the stock markets is leading to a bull trap right now that we think is the market's getting ready to turn over again globally for stocks.
Hi there, Kevin. Let's talk about the big valuation question then. We've seen them overextended for quite a long time. Is it a stock price decline? Is the stock price decline now a natural outcome of this?
Other asset classes that are richly priced today include corporate credit, especially here in the U.S., high yield bonds, junk bonds, and private equity, venture capital. We've already seen cryptocurrency go through what we think is a bust with so it's real estate. We're not quite as frothy as we were in 2006 at the height of the real estate bubble here in the U.S. and household debt to GDP in the U.S. is a little bit lower than we were back then, but we've had another real estate inflation here in the U.S. as well. In a number of ways, we think it's an everything bubble, and it's everything except commodities, perhaps, because commodities have been the one asset class, if you will, that's been left behind.
So, Kevin, tell us from here on, where do you see money moving?
Well, I think when you see people getting out of risky assets, they tend to flock first and foremost to cash and to the U.S. dollar. But we are in what we call well, it's a global debt to GDP bubble, and inevitably we think central banks are going to be coming to the rescue with more money printing and easing as the cycle turns down. And so we think that precious metals in this cycle offer tremendous value. If you look at how, for instance, how the gold to S&P 500 ratio performed during the housing bust, it was up over 200% gold versus the S&P 500. And then that's in the tech bust, and in the housing bust, the gold S&P 500 ratio was up 300%. Since that time, we've had about a 7-year plus of bear market or consolidation in gold, while the S&P 500 has raged higher. And so we've had a kind of a long consolidation in the basing pattern in this gold to S&P ratio. So we think that that gold is poised once again to outperform in kind of this double to triple range versus the S&P, and precious metals will be a good place to hide out.
So precious metals, that's the key word coming in from Dave there. But Dave, Kevin, just before we let you go, India as an emerging market play, where do you see that in the overall scheme of things? And would you also, perhaps, look at being cautious on India given the contagion impact that you're anticipating?
Well, currently we have no positions in India. However, in terms of emerging markets, we think that India has one of the best growth prospects out there. We're just concerned about emerging markets at large right now because of the risks that we see in China from the historic credit bubble that there is right there, that we think is in the process of bursting right now. Compared to China, India is the other billion-plus population country that we think is the emerging market that you want to be invested in longer term. There's several major differences in the opportunity between investing in China versus investing in India, but one of them is the working age population, and China has an aging working age population that's about to go into decline for the next decade, much like Japan peaked in its working age population at the height of its bubble in 1990. And India, on the other hand, has a growing working age population, and that's a pretty exciting underlying fundamental trend for the country. The other big difference, of course, between India and China is that India is the world's largest democracy, and China has moved much more into a totalitarian style country. The opening up and reforms that they had started under Deng Xiaoping have really started to go the other way under Xi Jinping, and given the extraordinary credit bubble there, where they've created $40 trillion of debt and through asset growth in the banking system, and another 40 to 50 trillion of off-balance sheet debt in the banking system in China. We think that they have an enormous non-performing loan problem that's ready to burst. But so longer term, we think the opportunities in India are great, but we have valuation concerns. We have emerging market contagion concerns about investing long there right now. The PE is pretty high in India. When we look at the aggregate free cash flow of India's non-financial public companies, also we found that it's one of the few countries actually today where in aggregate the free cash flow is negative. And so there's some underlying fundamental accounting concerns and valuation concerns that make us a little bit hesitant today to invest in India.
Kevin, thanks so much for joining us. Great speaking with you, and on that detailed report, an extremely bearish strategy coming in from Crescat Capital. It'll be interesting to see how things pan out.